welcome to the monthly roundup from Kepler Trust Intelligence, brought to you in association with Schroders. Join me, David, and guest host Joseph as we discuss the most interesting news and hot topics for investors from the last month.
And in this month's episode, Ryan celebrates the birth of his second child and a promotion to lead presenting duties, which I promise not to call a steward's inquiry into, with a run through of the news, looking at the outcome of Pacific Assets strategic review and a look at some more blockbuster IPOs.
We swap one Joe for another, with this month's version summarising his namesake's Trust Issues podcast with BASC, as well as some of the results from the past month.
Meanwhile, David recaps results from SCP, runs through the outlook for wind farms and reveals which investments were popular in June.
Thank you both. And as promised, we start with the news and the outcome of the Pacific Asset Strategic Review. Now, just before we do, it's probably worth giving a little bit of background on how we got here. First, Sentia Group, who are the parent of PAC's management company, Stewart Investors, did some internal restructuring, enabling the transition of duties from one of their affiliates to FSSA investment managers. This followed shortly after long-standing fund manager David Gate left Stewart Investors and therefore the Pacific Assets Trust, and the board triggering the review.
To put us out of our misery then, Ryan, what was the outcome of the review?
Well, the trust will be combining, subject to shareholder approval, with Schroder Asian Total Return, or ATR, as well as offering a partial cash exit. This will result in a much larger asset base for ATR, making it one of the largest Asia-focused trusts in the sector. And the board are also using this opportunity to amend its fee structure to a tiered model, passing on the new economies of scale achieved. In addition, Schroders will be contributing to the costs involved in the transaction, and also the performance fee will be reduced, although it's worth noting that the performance fee will not apply to PAC's incoming shareholders to ATR.
Ryan, in terms of strategy, is there much overlap between the two?
Yeah, great question. Really important question as well. And there is actually quite a bit of overlap between the two. So ATR's managers, Robin Parbrook and King Fu Lee, have a completely unconstrained approach, allowing them to focus on stocks on their own merits rather than because of any benchmark allocations. They also have a strong consideration of risk metrics, which should feel familiar to shareholders of PAC. Obviously, there will be differences between the two, especially in terms of current positioning. But in terms of philosophical overlap, we think this is about as close a match-up as the PAC boards could have managed, whilst ATR has also taken some positive steps in terms of shareholder-friendly measures.
I think that sounds like a really positive outcome. But now moving on, I think continuing in this thread of optimism, Ryan, you also noticed the Bending Spoons IPO last month. What are the implications of this? Yeah,
quite right, Joe. Bending Spoons has been a long-term private holding in Europe. Baillie Gifford had a big stake in it, and it's now made its debut on the NASDAQ in June, following on some big IPOs earlier in the month, which we'll get back to later. And when it did IPO, it beat its target range by about 10%. Now, this isn't quite SpaceX levels, but it is another example of a highly valued private company IPOing for an even higher valuation. And sort of just taking a bit of a step back and considering the doldrums we were in just a couple of years ago, this is a really positive step, especially considering that Bending Spoons is a European company rather than the same old Silicon Valley giants.
Yeah, it certainly is. And we won't give any spoilers just yet, but we will be coming back to this topic later on in the podcast. So keep listening and watch this space. Back to Bending Spoons. Who are the real kind of winners from this?
Well, clearly the most direct winners are the long-term backers, and this includes Baillie Gifford's Schiehallion Trust, or MNTN, and the Baillie Gifford European Growth Trust, the latter of which was kind of needed a win, really.
Indeed, Ryan, and I think that's a really key point. It's something I've touched on in an upcoming piece. So for those listeners, make sure you are registered to the KTI website in order to check that out.
Yeah, good timing on that piece, actually. And there are also some more indirect beneficiaries in the other private equity space. So with the likes of SpaceX and Bending Spoons showing there is an appetite for good companies listing, it could open the door for more private companies to come to market. And with that in mind, the private equity and venture capital trusts could start to realise some of their own holdings, and that would really validate their NAVs. Now, if this were to be the case, the current wide discount seen pretty much across the board in those trusts could well prove a compelling opportunity.
Yeah, really interesting, and will be interesting to see how things kind of progress with some big AI-related IPOs potentially coming down the line. Now, just to puncture the positive vibes, Ryan, you've got some news from our favourite activist, Saba Capital.
Yeah, indeed I do. All this, though, this relates to their holding in Schroder UK Mid Cap, or SCP, in which Saba had a near 20% stake.
I note the past participant in that statement, Ryan. Does that mean there's been a change?
Yeah, ever observant, Joe, it does indeed. The trust has undertaken a tender offer, which has given the activists the opportunity to exit their position, albeit at the expense of scale, with SCP's assets falling by about a third. Now, while this isn't great for the trust, it at least removes one major question over its future, as this deal also agrees a 3-year truce between the trust and Saba. Now, in more forward-looking news, SCP also had results in the past month, which means we can wrap up the news and hand over David to cover those.
Yeah, so the results cover a 6-month period where, it should be noted, UK mid-caps faced quite a challenging backdrop. Obviously, we saw the outbreak of the Iran war, which conspired to push up the price of oil, which has raised worries over higher inflation and consequently higher interest rates, which kind of came at a time when people were expecting / hoping rates would go down. Mid-caps, which of course are out of favour anyway, which obviously we've talked about a lot. They're more attuned to that kind of waxing and waning of sentiment towards the UK economy, certainly than the FTSE 100 is. Even though it should always be pointed out that the FTSE 250 is just as internationally focused, given around 2/3 of the index's revenues come from abroad rather than the UK.
Now, David, that's quite a lot to take in. So I'm guessing then it's been a pretty tricky period for SCP.
It was, although while SCP's NAV underperformed its benchmark, its share price actually outperformed. Now, that wasn't helped by the trust's use of gearing, which obviously works in the opposite way you want it to when markets are falling, albeit that only had a modest negative impact on returns, but still. Other detractors included the media business Future and the private hospital operator Spire Healthcare, although that was partially offset by exposure to financials and industrials, including the asset manager Man Group and the shipbroker Clarksons. Now, despite this performance, it should be noted, as we always say, that UK mid-caps do remain extremely attractively priced, especially when you consider their longer-term outperformance. Now, I've written a couple of articles on this exact topic, so I'll give a plug for them. One of those for KTI itself and one for TrustNet. And I'd urge listeners to kind of read one or both of those. It's, the kind of sheer scale of M&A activity within the UK market just continues to astonish, really. Now, sticking with the UK, Joe, in Ryan's absence, you covered Rockwood Strategic's annual results. What were the main highlights here?
Thanks, David. Yeah, with Ryan off on paternity leave, I honourably volunteered or picked up the duty of looking at what manager Richard Staveley had delivered from his portfolio of UK microcaps. Now, before we go into some details, I think it's worth adding a little bit of context. The latest 4-year results run through to March, so March 2026 in this case. And over that period, Rockwood delivered a NAV total return of 7.1%. Positive return for Rockwood, and that highlights over the period includes some key stocks like Capital Limited, which nearly doubled. Similarly, Vanquis Banking, which also performed very, very well and justified the manager's high conviction approach there. But over its financial year to just 1 month prior, the trust had actually delivered a NAV total return of 19.4%. So I think it's very clear to see there just how hard the trust was hit in the last month of its financial year, given the war in Iran. Post results, however, Rockwood has bounced back sharply with a NAV total return of nearly 19%, and that's really been aided by M&A activity. And I think this is a return to some figures and at least a narrative of that those familiar with Richard's track record will be very much used to.
And how did this sort of volatility affect the trust rating?
Well, it did move around, Ryan, and in fact, it had a very short period where Rockwood traded at a discount. And that's something that has not really been the case in the trust's history. However, this did prove short-lived, with the trust now back at a premium and issuing some shares.
And what does all of this short-term performance mean for the long-term returns?
Well, over 5 years, Richard has still performed very, very well. The trust is up almost 100%, so doubling, despite the weaker narrative about the UK smaller company space that has persisted throughout this period. And we think that's a real testament to Richard's hands-on approach, which has really managed to unlock value in a number of companies and really rewarded the patience of his shareholder base. And I think a really good example of the impact of that influence over time is via Richard's investment in Kepler Trust. Having purchased it in May 2022, at a point when its market capitalization was below its net cash, Richard and his team really regularly engaged with the management around how they allocated capital, but also their approach on things like buybacks and dividend policy. This positive engagement saw it re-rate strongly and prompted Richard to sell the position in its 2026 financial year.
A nice overview there, Joe. Thank you. Now, for our final results piece, Ryan, you have Cordiant Digital Infrastructure. What are the main takeaways from this?
Yeah, thanks, David. Cordiant, or Cord, as per its ticker, released its annual results at the end of March, with a pretty remarkable NAV total return of 16.3%, share price rise of 24.3%, far in excess of the 9% goal. Just on a bit of a tangent as well, it's worth noting that all three of these results we've covered run up to the 31st of March, with the last month being very challenging for those markets. So often when you get a bad month at the end of the period, it sort of skews the full results for it, as we've seen because of the war in Iran. But Cordiant has not suffered this, just shows that maybe infrastructure is that diversifier that people are looking for. This has now led to NAV total returns of about 50% since inception, just over 5 years ago, which is really very strong for an infrastructure trust.
And Ryan, other than that headline return, what do you think are the highlights from these results?
Well, the dividend also increased. One of the attractions of the infrastructure asset class rose 2.3% to yield about 3.5% now. Dividend cover remains very robust, hasn't changed really. And this has all been supported by strong earnings growth. As for the capital uplift, this was driven simply by just good operating performance in the underlying holdings, of which range across a number of European areas, as well as the development of the Prague Gateway project, which is one of the key projects in the CRA holdings and one of the things that investors have most been looking out for.
So how does this all affect the outlook?
Again, it just remains very positive. The managers have continued to deliver on or beat their really ambitious goals. The trust has shown the attractions of a growth-orientated mid-size infrastructure trust and what this can offer investors. And thirdly, slightly sort of tangentially, it shows what a narrowing discount can do for share price returns. Now, this trust was having a really difficult periods going into 2024, but share prices have more than doubled since the nadir. The discount has come right in, trust has continued to deliver. If you've just seen the performance of NAV, you'd never know there was an issue, but shareholders have been able to really capitalize on that. For those brave enough to add in early 2024, or those patient enough to stick with it during the periods of weak sentiment, would have done really well.
Yeah, a nice strong rallying call to end on there. Now, moving on to our Trust Issues podcasts. We recently had Christopher Berrier and Rob Furlong from Brown Advisory US Smaller Companies on the show. The Russell 2000 has had a really strong start to the year. So what were their thoughts on the rally there, Joe?
Well, if you're a Lord of the Rings type anorak, you'll be very pleased to hear that Chris called it one theme to rule them all. And I think there's no surprises there for guessing that one theme is AI. So while the Russell 2000 is up around 20% year to date, at least at the time of this recording, it's been an extremely narrow rally, driven almost entirely by AI. And it's that magnitude of gains that's particularly surprising. You know, we're not talking about share prices rising by 100 or 150%, which in isolation is a very strong return. We're talking about companies with 1,000% gains over a very short time frame indeed. And I think that poses a challenge for quality-focused managers with that long-term horizon.
And how do they differentiate between the AI winners and the AI potential losers?
Well, Rob very much described it as two camps, really. The AI winners, where you can do no wrong, and those perceived AI losers, where strong earnings and good management simply don't matter because the capital flows out regardless. So the focus here shifts to finding a catalyst that's really strong enough to flip that perception. And that seems to be more important than the fundamentals currently. I think software was the most extreme example. It was from the stock market darling with high growth and high margins and excellent scalability to a seemingly uninvestable space of the market almost overnight. And this is purely down to the coding potential of AI. So the team here have really strict criteria for software names, vertical specialists that are hard to displace, businesses with heavy data angles and companies with a regulatory stickiness, and the financial services clients being the obvious example there.
And on the M&A front, obviously, I very briefly kind of mentioned, the wave of M&A deals we're seeing in the UK. Is the same happening across the pond?
Well, really, deal volumes in the Russell 2000 are actually at historic highs on a rolling 12-month basis, but again, heavily concentrated in banks and biotech, where they believe there's too many players for the pool. Software, again, is the interesting gap, with plenty of willing sellers, but not that many buyers. But the team have around 10% of the portfolio taken out in the last 6 to 9 months, which they see as a validation of that quality approach. Own things that other people want to pay for, and the M&A will tend to underpin those risk-adjusted long-term returns over time.
A really interesting overview there. Thank you, Joseph. Now, moving away from the equity market, we went back to basics when you, David, spoke to Matt Ridley from Greencoat UK Wind. What did he have to say in his latest podcast?
Yeah, so as well as the podcast I did with Matt, I should mention that we also have a full research note up on the website. So before I get too much into the weeds, I definitely urge listeners to have a read of that if you haven't already. Now, I think getting back to basics of renewable trusts in general is important at the moment because they have undergone a really tough time with rising interest rates and soaring energy prices hammering sentiment. However, you only need to open up Google Finance and look at Greencoat UK Wind's dividend yield, which is over 10% at the time of recording, to see the real attractions here. Now, of course, just because the yield is high, it doesn't automatically make it a good investment. In fact, we'd suggest that one should be skeptical of high yields because they can often be value traps. That said, we don't think this is the case with UK Wind, where the dividend really is the key component of shareholders' return. And as Matt says, UK Wind has paid a staggering £1.4 billion in dividends over the course of its life. Its dividends are explicitly linked to inflation. Previously, it was retail price inflation. Now it's moved to consumer price inflation because of a few government consultations and changes. So they have kind of, that dividend has risen by or above inflation every year. Now, this makes the dividend, in our view, very attractive and extremely resilient.
So, David, I think it's pretty clear from that the dividend is very, very important, but so arguably are the actual wind farms. Did Matt have anything to say about the actual portfolio UKW owns?
Yeah, we did get into a few things here. I won't run through them all, but he did briefly talk about the political climate surrounding renewable energy and the potential for a government to be elected that is hostile towards it. In short, I think the hope is that a reform government would be a bit more pragmatic if and when they get into power. We also spoke about wind as a source of power. Clearly UKW is very much kind of focused on one specific type of renewable energy. In short, wind is variable in the short term, but over longer periods of time, it does tend to be much less variable. One interesting thought to leave you with quickly is on the kind of share buyback versus reinvestment point. Now, given UK Wind has been on a sustained discount for a while now, it has been focusing on buying back shares at a level that is accretive to shareholders. However, clearly, if it continues to do that in perpetuity, then the risk is that it's just essentially in a kind of slow managed wind down, which, given the trust keeps passing continuation votes, doesn't seem to be what shareholders want. So the team is very much looking to get back to making a disciplined return to new investments this year. And Matt spoke a little bit about the kind of wish list that the team has built up over the past couple of years.
Thanks, David. I think it's really, really interesting oversight. But now moving on to our Stat of the Month feature. Ryan, I think you're covering this again this month. So what caught your eye in June?
Yeah, well, it's more of a sort of an ongoing stat, but after working with Aberforth on their smaller companies trust, a recent note that we put out, they pointed out that the yield of the Deutsche Numis UK Smaller Companies Index is now above that of the FTSE All-Share.
That sounds like an unusual thing.
It is, yeah. I mean, just to put some numbers on it, I think just before I came in, it looked like the Numis index is about 3.5%, FTSE is about 3.3%. But looking forward to the year forward earnings, the Numis jumps to about 4%. So like a big jump on that. Now, this is not something you'd normally expect of small caps. They are typically more known for their growth prospects. So for their yield prospects to be that of large caps, especially the FTSE, which is more one of the income-led markets globally, is quite a big surprise. In fact, this has only happened sort of a few times in the past few decades. The most recent time this came in was 2008, and before that 2001. For any of you who know your markets, know that was pretty much bubble territory. And then after this, there were periods of considerable small cap outperformance.
So what is causing this?
Well, two things really. One is sentiment. UK small caps remain very much out of favour, which is depressing share prices, helping yields go up. And two is strong underlying performance. The companies that are left in the UK small cap index are pretty resilient, and they are delivering strong earnings growth, and that's supporting the income picture. So you've got good performers, companies performing well, delivering earnings, sentiment being really, really weak, and pushing down share prices. So to us, it looks like a bit of an anachronism, could well prove an attractive opportunity, if not just for income investors, but also for those looking to exploit market inefficiencies.
Thanks, Ryan. I think that was a really, really good stat of the month, actually. But David, over to you. I think it's your turn to find out which were the most popular investments in June. What can you tell us about that?
Yes, I haven't actually written the article yet, so this is hot off the press, although there's going to be no prizes for guessing. Scottish Mortgage would top the charts with Polar Capital Technology in second. That's the third month in a row that's happened. Interestingly, also the open-ended version of PCT was in our list of most bought active funds as well. But I think the most interesting thing to note was over in equity land, where SpaceX entered the chat. It was in third place on both the most bought and the most sold lists. Now, that presumably kind of talks to the roller coaster ride that investors have seen in its very short-lived life. Shares that were priced at about $135 rose 33% in a space of 4 days to go over $200. But they've since fallen by 25% to 149. So it's certainly not one for the faint-hearted.
Well, as the guest host, I think it's only right that I get the chance to answer those difficult questions. Ryan, have you been tempted into that SpaceX IPO?
I mean, short answer no, long answer no. I put SpaceX in the same category as gold and Bitcoin, which for long-term listeners will know are not my favorite investments. I can see the appeal in it. I can see why people want to go into it, but I just can't get my head around that valuation. I mean, within it is the Starlink business, which has done really well. Like, that was doubted when it first came in, and it's making decent money, but the rest of it doesn't go anywhere near close to justifying the valuation, especially things like the space data centers, which, like, just if you scratch beneath the surface, just totally illogical. And I think is going to go down as one of those unfulfilled Elon promises. I mean, just see the new Roadster, which is 1 year away, has been for the last 10 years. Autonomous driving, I think that was first promised in 2015, and it's still 1 year away. Humanoid robots looking like it's going down the same track as well. Now, I do believe in some of the other IPOs, which is encouraging. Bending Spoons, obviously a really good success. I would have capitalized through my attempted purchase of Schiehallion. Unfortunately, a well-known Bristol-based platform decided I was not sophisticated enough to buy an investment trust, but that's a rant for another day. But it is encouraging for those who picked Molten Ventures for their trust of the year, which has put me top of the charts at the halfway stage. They're invested in this, well, they're exposed to this space. So nice to see the IPO market is coming back to life. Hopefully Molten Ventures can continue to deliver me the bragging rights in the office. But I think elsewhere things need to come back down to earth a bit. In fact, I've actually recently added to my SIP portfolio, putting some defensiveness in there with the addition of Global Opportunities Trust. And I think this has a much better chance of outperforming over the next 6, 12 to 18 months, especially over something like SpaceX, which I think is looking more to the downside than the up. Now, on that jolly note, puncturing the optimism that has otherwise gone through this podcast, David, what about you?
Yeah, I'd agree with everything you said, I think. And just adding, don't really think I want to be encouraging the colonization of Mars either. So, I think I'll leave that alone. I don't think, I might be, we all might be fairly young in our kind of investment journey, but yeah, I don't know. The volatility does worry me a little bit. That said, I do have some exposure to, SpaceX, Anthropic, all these guys through Scottish Mortgage, through potentially Allianz Technology. So there is a benefit there. I have been kind of like you, I guess, trying to think about my playbook for if and when markets do kind of get worryingly overvalued. And I think I've been kind of just looking at those exposures, Scottish Mortgage, Allianz, and it's kind of when do you start to take those profits that you've kind of locked in already? Probably quite close. And I think kind of emerging markets plays into this as well. You see the volatility in South Korea that we've seen in SK Hynix and Samsung. That's definitely an area I'm thinking about recycling a little bit of capital. I think that's what I'd say on SpaceX. How about you, Joe?
Well, SpaceX isn't something that I have invested in. I'm not doing a lot of that at the minute because I'm saving for a trip to Japan next year. But I think with the SpaceX story, it's very, very difficult to ignore it or to kind of get caught up in the excitement. The post-listing frenzy we saw, I think, was largely driven by sentiment. Few wanted to miss out on that story and what SpaceX could do in the first few days, as you've said before. The share price rocketed, pardon the pun. But I think it's really quite nice, actually, that the market has taken a bit more of a considered view, because when you actually look into the finer details, and this is something we wrote on for the Daily Mail the other week, SpaceX is made up of three main businesses. One business we all know, Starlink, very profitable, 10 million subscribers over 155 countries. It's generating most of the profits for SpaceX, that revenues for SpaceX, sorry. But the other divisions, notably their launch and AI, as exciting as they are not yet profitable. So I think that's just a reminder that the excitement's there, but there's a lot of work to do for it to be, a proven climber. And of course, with expectations being extraordinarily high, I think that cuts both ways with a stock like SpaceX. You underdeliver, and the shares will be punished. You meet them, and SpaceX may even face the same paradox that Nvidia has encountered. Strong results greeted with a shrug. So a very long-winded way of saying, David, no, I haven't invested. Money is going elsewhere at the moment, but I do think it's a very interesting story that we should all keep an eye on.
Well, what a philosophical way to end the podcast. Thank you very much, Joe, for joining us. And thank you, everyone, for being here on the monthly Roundup, brought to you in association with Schroders. For more investment trust news, insights and updates, head over to the Kepler Trust Intelligence website, and we hope to see you again soon. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that, if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.